On to the 80 Money Show, it's time to have the first discussion on board, and the US Fed is definitely has raised the interest rates by another 75 basis point hike, and the chair, Jerome Powell, vowed to keep at their battle to beat down inflation. Now, America, as we know, is the world's largest national economy and the leading trader, and the tremors coming from there is definitely going to impact the world economy in terms of tightening of the liquidity that we are seeing now happening, and going further it can actually impact in a bigger way. Now, we did see this happening, the impact of this in the equities market. The global gold prices are also stumbling, and the move in the short-term rate is also seen to be on the upside. But all this affects many consumers and businesses, and especially when we see the loan rates in America that are seen to be the highest since early 2008. Coming to the forecast, the dot plot makes it clear that there is no stopping in the interest rates hike. But as the investor, how to read into this and how will the yield curve get affected? Also in this discussion, we'll talk about another big economy, that is China. What's happening there and the impact of India? Let's find out all of that. And for this, we are being joined by a special guest, Mr. Atul Joshi, who is the founder and CEO of Oyster Capital. A very welcome to Atul on to the ET Money Show. And firstly, we want to have your view on the Fed's comment and the US yield trajectory. The step is very much clear that it's going to be an upside. They will make it all to fight the inflation. But how to read into this from an investor's point of view? And given a fact that we are already having the impact, be it on equities, gold, and even bond yields, which asset class for the rest of the year is you can be picking for our investors?
US is a very unique economy. They are import dependent, unlike, let's say, China, which is export dependent. So what really happens, at the US Fed, the moment they raise the rates, the US dollar index goes up, US dollar starts appreciating against all the currencies. So their import cost actually comes off. And that really helps them reduce the inflation over a period of time. Now, the speed at which Fed is trying to increase the rates and the kind of trajectory they have given, upwards of 4.25%, it means that they are going to be increasing maybe at 50 basis points going forward instead of 75 basis points, what we have seen in the last 3 rounds. Now, US also has one more advantage. One, of course, I mentioned is that the cost of import comes down immediately because the US dollar appreciates. The second impact is that the investors move their money from emerging markets into the US markets after the high yield US treasuries, US bonds, etc., etc. So you would suddenly see that the money is moving from emerging markets into the US, which again helps them in their curbing the current account deficit through the portfolio flows. We have seen this many a times, whether it is 97, 2000 .com, 2008-9 global financial crisis. Several times we have seen the US fixed income market is where the investors want to put in their money. Now look at it from the other perspective, which is, let's say, the rest of the world. Their currencies have already depreciated. For example, India, the currency moved from 76, 77 and a half to almost 80 and a half plus, which means that the cost of crude, all the imports, technology, machinery, everything is going to go up. That's where the balance really lies, that the US is going to benefit by raising the interest rates. It will actually help them to curb the inflation through the portfolio investments and through the cheaper imports. Come to Indian side, the same thing is going to hurt us because we are actually import dependent, but our currency actually is depreciating. The money is going to flow out. The investors in fixed income into the equity market are going to move their money into the asset classes of fixed income in the US. Now, the balance for India would be that, where the economy is going, we have an advantage that we are very domestic economy. We are not really an export-oriented economy. Now, that's where we need to safeguard our interests, which I think the government is doing, whether it is bilateral trade with Russia or in some other manner. But US, if I again look at it from the GDP perspective, the latest GDP estimate, which has just come a couple of days back from Fed of Atlanta, is just 0.3% for Q3. So, if I was to go back to the last two quarters, minus 1.6% for the first quarter and minus 6%, 0.6% for the second quarter. Now, this is just an estimate, which is saying Q3 is going to be just 0.3% GDP growth. That's where I think the US really needs to apply its mind, whether it is retail consumption, whether it is unemployment, or whether it is the real domestic ability to buy new houses. All of these indicators are somewhat mixed at this moment, but certainly moving towards the negative territory. Once they move to the negative territory, which they are actually below the long-term average, most of them, but sequentially they really need to move down further. I think that's where the US will have to think of a balance between GDP growth and the inflation. So I guess the overall summary would be that yes, US fixed income markets will do well. US inflation will come under control, but at the cost of emerging markets where the inflation will rise because most of them are import dependent.
Well, yes, point taken, and the summary was very much to the point, Atul, but very interesting point made there where you did touch upon the consumption. When we look at the consumption basket, especially that's been hit by the inflation in some of those developed markets, but India, the consumption story is building up quite very strongly. What's your view on that, and how resilient you find Indian markets, especially the equity markets, because what we are seeing is the decoupling factor playing in. What's your view on that?
See, the Indian consumption, I'm not very bullish, to be honest. I feel the numbers that we are talking about are kind of slightly of the past, and the past would just mean 6 months. If you were to look forward, especially the rural consumption, there are a few things which have happened. Number one, agriculture is going to suffer. We already know that the area under cultivation for rice and pulses is substantially down. We already know that the inflation is taking away a major part of the savings. The third part, though the urban consumption has gone up, there are a few things which the government has done right, which I was mentioning. India has been able to manage things very well. Just to give an example of, Har Ghar Tiranga. We might find it a very small step, but the kind of consumption it has led to has revived so many things. But that's just one-off. If I look at cotton yarn as an industry, for example, cotton yarn, nearly 50% of the industries in Tamil Nadu have shut down. Almost a similar percentage spinning mills in cotton yarn have shut down in Gujarat. So there is going to be unemployment. There is going to be an issue of consumption, but that's going to be sequentially seen over the next 2 quarters. I think the next 1 quarter, it would be not very visible because of the festival season. But once that is over, sometime November, second half onwards, we would see consumption coming off. If I was to look at auto sales, for example, auto sales headline numbers I'm not looking at, but if you look at the actual sale to the final consumer, all of them are by and large double-digit negatives, whether it is tractors, four-wheelers, commercial, or two-wheelers. So I guess consumption story, yes, last 2 months you might see good numbers. Going forward, I'm not very bullish, especially on the rural side. I think we're going to see a lot more challenges in survival of the consumption.
Okay, so we are in the wait and watch situation for the survival of the consumption. That's the word coming in. But Atul, in the consumption basket, what the story was panning out was the China +1 policy. Now, China is dealing with its own set of problems, right? On the contrary, they are cutting down their interest rates, although marginally, but that's the situation. How do you see China performing in the times ahead? Will the global growth slow down? The concerns and the overhangs related to that, can the pressure in China can be much more than what we are witnessing right now? And can India be a beneficiary of the same? What's your view on that?
See, China, I think, started looking at, the global slowdown, reduction in consumption as early as April 2022. They also saw some domestic problems coming forward. So in April 22 itself, that is immediately after the Ukraine-Russia war, they actually reduced their CRR by 25 basis points. Going forward, they again reduced their bank rate by 20 basis points. So China is actually trying to support the consumption, industrial growth, etc. on one hand. Whatever numbers come out, the exports from China have actually increased. The last August numbers that have come up, and they've increased substantially. We are talking about a double-digit growth in exports from China. China also is able to reduce its cost of imports, especially of crude from Russia, of coal from Russia. So China is playing on the cheaper imports of the raw material, and China is an exporter of the finished goods. So China is now, I think, a mixed bag at this moment. They're trying to boost the domestic demand by reducing the interest rates, trying to help the worst of the real estate market, which has really suffered. But at the same time, China has been able to reduce its input cost, both on crude and on on the coal. The issue China is going to face is the final consumer of China, which is US, which is Europe, and let's say it's the two advanced economies of Asia, which is South Korea and Japan. Together, these four baskets would be about 80% of the exports of China. And that's where the consumption is going to come down, which means that China's exports are going to suffer. So China at this moment has to put in money from its own reserves to see to it at least the domestic economy survives. And I think they have read this market much before. I think the rest of the market, they've reacted. Rest of the markets have reacted. China read it by April, saying that I need to support my, kind of real estate market, which was dwindling. They knew that their exports are going to suffer, and they started immediately importing from Russia coal and crude, which is the input. That's where I think they're trying to manage. And I guess as far as the Asian economies are concerned, their linkages with China are very strong. And I think if these Asian economies among themselves are able to do bilateral trade in local currencies rather than in US dollar, I think they would all survive.
Okay, so a lot of factors at play, and especially on the currency front, India once again managed to breach a record low level, but not coming to that. But Atul, you did touch upon the real estate market, and China is definitely having the real estate crisis right now. But in the US, what Jerome Powell is now warning is that the once red hot in housing market can see some price correction. So China is one that we are seeing this impact happening. US is also seeing the tremors being felt. But what about India? From the investor's point of view, because we discussed the personal finance in this show, wanted to get a perspective on, in India, are you expecting some kind of a correction in the real estate prices? How should one look at this?
See, definitely. I would just put in one data. Again, it is coming from, let's say, the personal consumption side. Nearly, if I was to look at the total individual borrowers, whether it is personal loans, housing loans, credit cards, vehicle loans, etc., from the entire financial markets, which includes banks, NBFCs, and MFIs, on an average, I think it's about 33 crore people are the borrowers. Now, these 33 crore people, their salaries have not increased in the last 6 months, but their cost of actually servicing the EMI has gone up substantially. That does not leave them much room to do further consumption. Or those who are sitting on the fence, assuming that they will be able to afford certain EMI, and now have to think about, I really need to save money and I can't afford this EMI, or I move from 2 BHK to 1 BHK, or Mumbai to, let's say, the outskirts of Mumbai. So there is going to be a shift initially in the consumption pattern, which is 2 BHK, so larger house going to smaller houses, main city going to the outskirts of the city. And then the second phase would be where people would actually desist from getting into a new loan contract, especially for housing. So I guess overall the inventory is going to build up, and we will see, reducing trend in the real estate sales, which already is by and large visible.
Okay, but Atul, my last question to you is on the gold prices. We are seeing that the gold is now losing its shine, but from an investor's point of view, I know that there's a negative correlation when it comes to the interest rates and the gold prices, but is the price correct to enter for a long-term perspective? What's your take on the gold prices?
See, long term, we need to define, for each individual, it's different. But, gold is always an insurance. It's readily and cashable any point in time and anywhere in the world. If I was to look at the gold prices, I think it's kind of range bound, plus or minus $150 from where it is today. And that is probably true for the next 9 to 12 months. I don't see it dropping below, let's say, 1600 kind of a benchmark, nor does it seem to be going up above 1900 in the short term. So I guess it's range bound. One can always wait. The issue from the Indian side is going to be that if the dollar depreciates, the landed rupee cost of gold is definitely going to go up. So, they may actually look at dollar rather than gold, or, the dollar hedged price of the gold, instead of just looking at the rupee price. And I think there is possibility that some part of the portfolio can actually move into gold, but with a much longer view.
Okay, so gold can always be a part of your portfolio, but you have to define like what's the term that you are looking at, but good to have gold. But Atul, it was good to have you as well for this interesting conversation. Where is India standing in terms of its global footprint, as well as how the US and the China markets, the pressures in those markets going to be impacting the India as well. Thank you so much for joining us today on ET Now.